This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and thank you for joining us on Money Talk this afternoon. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal. Then we go to Matt Hendricks of Sprott Asset Management, followed by a two-part interview with Dennis Mitchell, who's a Senior Vice President and Senior Portfolio Manager at Sprott Asset Management. And after the news, to Gus Papagiorgio, who is Associate Director of Technology Research at Macquarie Capital Partners, and he takes a look at Shopify's earnings report. Then to Paige Ellis, who comments on Bombardier, and on to David Prince, who is the founder and president of Harbinger Capital Markets Research, for his outlook. And we conclude today's show with Amber Kanwar's interview with Gerald Celente, who is global forecaster and publisher of the Trends Journal. But first, we'll go to My Talk with Dave Sally of the Ottawa Business Journal. It is good to be joined by Dave Sally of the Ottawa Business Journal. How are you, Dave?
I'm great, John. How are you?
Okay, trying to remain cool in
I hear you.
Face of the markets and the weather. But, Dave, it was a big week for Ottawa technology companies as Mitel Networks and Halogen Software both reported strong second quarter earnings. Meanwhile, next year's CFL championship is a long way off. Many Ottawa businesses are already in the mood to cheer this week after Ottawa was officially awarded the 2017 Grey Cup.
Well, that's right, John. Well, let's start with what turned out to be a better-than-expected second quarter earnings report from Mitel Networks. As you may recall, the Canada-based telecom firm suffered a bit of a setback last month when its proposed bid to buy California-based Polycom fell through. But on Thursday, Mitel got a welcome bit of good news when it announced it recorded second quarter revenues of $307 million U.S. That's up 11% from the same period in 2015 and slightly above the $285 million to $305 million range that Mitel had led analysts to expect. Mitel's earnings were 19 cents per share, which also exceeded estimates. And CEO Rich McBee said the company continues to see growth in all market sectors, especially its cloud-based services. Strong earnings have allowed the company to cut its long-term debt under $600 million, and Mitel predicts revenues for the third quarter will be in the $275 to $295 million range. Now, as for the Polycom deal, Mr. McBee tried to put a positive spin on the situation. He says the company still sees plenty of other opportunities with potential merger partners, and he hopes some of those can come to fruition.
And another high-profile Ottawa tech firm made a bit of history this week when it reported its earnings.
Yeah, that's right, John. For the first time ever, Halogen Software has finished a quarter in the black. The Canada company makes cloud-based human resources management software. And it reported net income of $283,000 U.S. for the three-month period ending June 30th. That's compared with a net loss of $2.3 million in the same period last year. Halogen CFO Pete Lowe says that reflects the company's revenue growth and its drive to find more cost efficiencies. Halogen's second quarter revenue was $18 million. That's up from $16.1 million a year ago. But it wasn't all good news for Halogen. The company has not added as many new customers over the past 12 months as it had hoped, and revenue in the Asia-Pacific region fell 5%, partly due to a lack of new customers. As a result, Halogen recently had to lay off workers at its London and Australia offices, and it closed its office in Amsterdam. As a cost-saving measure, the moves are expected to save the company about $2 million a year.
And finally, the Ottawa Redblacks celebrated a major win of a different sort for the franchise and the city.
Yeah, that's right, John. It was what was probably the worst-kept secret in Ottawa was finally revealed last Sunday at TD Place Stadium. Before the game, CFL Commissioner Jeffrey Orridge made it official. Ottawa will be the host of the 2017 Grey Cup game on November 26th, 2017. Of course, the capital is a fitting choice for the 105th Grey Cup celebration, since next year is, of course, Canada's 150th birthday, and Ottawa has already landed a number of high-profile events as part of the celebration, including the Juno Awards. So now you can add the Grey Cup to that list. And local businesses are certainly in the mood to celebrate. Elizabeth Kilbert owns the Unrefined Olive in the Glebe and sits on the Glebe BIA's board of directors. She calls the Grey Cup a huge opportunity for local merchants. She says thousands of visitors are expected to come to the Glebe during the whole week leading up to the game and for the game itself. And she says she hopes many of those people will use their downtime to pop into local stores and maybe buy an item or two. Overall, the CFL says the game should generate about $100 million in economic activity for the Ottawa region. And that's definitely news worth cheering.
And Dave, what's on the OBJ radar for the coming week?
Well, John, one of Ottawa's biggest retail projects in decades is set to be unveiled on Wednesday. The Rideau Centre will give media an advance tour of its $360 million expansion that night, and then will officially open its new wing to the public on Thursday. The expansion features nearly 30 new stores, including the first Simons location in Ottawa.
Well, that's a great update, and we'll talk again same time next week, Sunday, 2 p.m., and hope you have a great week.
You too, John. Thanks.
Now to my weekly talk with Matt Hendricks of Sprott Asset Management. Well, it's great to be joined by Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. How are you, Matt?
I'm very good, John. How about you?
Okay, thanks. And I understand you attended the game last night.
Yes, I hosted a bunch of clients in a suite and watched the Red Blacks have a very exciting win over the Eskimos, and we all had a good time. Feeling it a little bit today, but it was well worth it.
It's been an interesting week. We had an interest rate cut in Great Britain, and that took interest rates down to 0.25 percentage point. And then on Friday, we had weak jobs numbers in Canada and very strong jobs numbers in the United States, which put a lot of pressure on the Canadian dollar. And taking a look at the month ahead, it looks like we're just going to be treading water going into September, but you never know when a wild card event can hit. So I guess what I'd like to reiterate is the fact that investors need a core, solid strategy and sleeves around the perimeter of that strategy, such as energy, precious metals, and then some of the specialty credit vehicles that you offer, and you might speak to that.
Well, for sure, John. We do talk about your core part of the portfolio, and certainly dividend stocks have been very popular in that aspect. And Dennis Mitchell, who joined us last year, runs our U.S. and our global dividend strategy, and he's doing very, very well. I mean, European stocks obviously have gone through a lot of volatility, but Dennis has done a great job navigating that ship, navigating currency. This whole Brexit deal has allowed him to find some very, very good stocks very cheap. And so he's been deploying some of his capital in some of these names that he's been following for a long time. But now the valuations are a lot lower, and that's when a smart investor buys. You want to buy in the low, and, you want to buy these stocks with a solid dividend. So, you either get to pay to wait or you get a nice little income stream. So I'm looking forward to your interview with Dennis Mitchell because he's a very smart guy and a very good stock picker.
Now, I also took a look at the energy fund. Of course, Eric Nuttall is the manager of the Sprott Energy Fund, and it is up about 38% year to date. And, of course, we played an interview with him last week, and that is a very important sleeve. And then the Gold and Precious Minerals Fund is up 124% year to date, and that has certainly augmented portfolio performance. Do you have a quick comment on some of the credit products?
Yes, I do, John. So we have three credit products, or three what we call alternative income products at Sprott. One of them has to do with asset-based lending. One of them has to do with pure credit. And the third one is factoring receivables. Two out of these three strategies are very unique in the Canadian marketplace, and we're very excited that we are one of the only companies to have retail products for this space. The returns have been phenomenal. The volatility has been low. And in a world where yield is almost impossible, these funds combined are generating anywhere from 7 to 9% net of fee with almost no downside volatility. So they're great products. if you'd like to hear more, then definitely talk to your advisor to give us a call or contact me. I'd be more than happy to educate anybody on these funds.
Well, the purpose of this discussion is to try and help our listeners win the battle for investment survival. And what I would like you to do is give us your coordinates for listeners and advisors who would like to seek your advice.
Absolutely, John. I'm always reachable toll-free at 1-866-299-9906. And always remember to visit sprott.com.
Well, that's it, Matt. Enjoy the rest of the day, and we'll talk again same time next week.
You too, John. Pleasure.
Okay, folks, stay with us after the break. Dennis Mitchell, who's Senior Portfolio Manager at Sprott Asset Management. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
All right, we are keeping our eyes on the TSX. It's up over 12% year to date, but of course you needed to be in energy as well as materials to participate in that upside. Joining us now is Dennis Mitchell, Senior Vice President and Senior Portfolio Manager at Sprott Asset Management, to discuss whether or not this is sustainable and where to invest. Dennis, good to be with you.
Thanks.
Let's first talk a little bit about the macro environment with respect to oil and the fact that we did see it dip below $40 yesterday. It surprised a lot of people.
Yeah, myself included, because the fundamentals didn't support that 20% correction that we've recently seen in oil. The U.S. dollar certainly didn't confirm that move. The U.S. dollar was weak as well during that period. So I think the rally that you're seeing today, up over 3% when it finished up, is sort of the reversal of a lot of that. You had a lot of shorts pressing oil down. They managed to get it below 40, as you mentioned, but there just isn't the fundamental support for further weakening. So you're probably going to see oil rally back up.
Does that mean then that the supply-demand dynamics are maybe a little bit more balanced than what we're currently seeing in the market price, and that the movement is really just attributable to traders once again?
Sure, that's part of it, but I think the near-term narrative, of course, is that global growth is low, and then after the Brexit vote, you're expecting it to be ratcheted down. In fact, you're starting to see those forecasts be ratcheted down, whether it's the OECD or the IMF. So the narrative, starts to take hold that growth is weak and getting weaker. We've got all this supply. We did have an inventory build today. So I think that's sort of what perpetuated the initial leg down, and then shorts pressed it. But again, there's no fundamental support for that. Growth is positive, robust. China's oil utilization continues to grow, just not at the pace that it was before. So I do think that energy is going to continue to recover. I don't think you're headed for $100 anytime soon, and Saudi Arabia agrees with me, and I think their opinion weighs a little bit more than mine. But I do think a fair range of 40 to 60 with bias to the upside from here is probably in the cards for us.
Dennis, it's interesting. I've talked to a couple people on the program today that are positive or bullish like you are. And I've got
We're paid to be that way, by the way.
Well, you are and you're not, right? At the same time, too, you as a money manager, you don't want to lose people's money. So in some ways, you're better off, if you don't believe there's growth, to just sit there a little bit. But that's not your view. So let me ask you this, though, because one of the other key drivers that we were touching upon just moments ago is the macro picture, and specifically what's going on in the UK, and that their data is showing weakness. How does that play out?
Well, so that's interesting, because a lot of people have advanced the narrative that there has been no fallout from Brexit because the FTSE 100, the UK broad-based index, is actually higher than it was before the vote. The purchasing managers' indices came out today and yesterday for services and manufacturing, and what you've seen is a precipitous decline in economic output in the UK in the month of July. So we're talking about the first time that they have meaningfully corrected or contracted since 2012, which is, of course, the Eurozone crisis. But the magnitude of the collapse from 52 down to about 47 or 48, depending on services or manufacturing, you've only seen that type of contraction in 2009. Okay, so in the depths of the financial crisis, that's the type of deterioration that we saw in economic output in the UK. That's what we're seeing now, and it's all tied back to Brexit, of course. You're seeing declines in new orders, you're seeing declines in hiring, you're seeing declines in pricing, and again, all of the quotes from C-level executives who were interviewed for the PMI surveys all indicate that it comes back to Brexit and the uncertainty going forward. So to put it in context, UK PMIs are now weaker than France's, and weaker than Greece's, and weaker than Russia's. Okay, so that gives you an idea of how much deterioration you've seen in the economic picture in the UK tied to the Brexit vote. So I challenge the narrative that there has been no impact.
I wonder, though, if that's going to be a very, very short-term kind of knee-jerk reaction.
Well, so if you're a CEO of a company that's got to make long-term capital allocation decisions, right now you have no idea what the regime is going to look like in the UK. On top of that, you've got tangible evidence now that your competitors and your peers are also delaying investment decisions. So why would you rush to make a long-term capital decision in the UK or in continental Europe for that matter when you can simply wait and see how things are going to shake out? Is the EU going to take a very, very truculent and combative stance with the UK? I don't believe so. Or is the UK, Theresa May did make Nigel Farage her foreign policy secretary. I think that's what the title is. Is there going to be a fractious relationship? And if so, what does that mean for negotiations? So I think most CEOs faced with the ability to defer a large capital allocation decision are probably going to defer that decision until they get greater clarity.
What do you think that might mean for the BOE, the Bank of England tomorrow, and Mark Carney's job? Yeah,
so Mark Carney used to be the governor of the Bank of Canada, and when he was here, he was very ahead of the curve, a lot of foresight. He's tried to do the same thing as the governor of the Bank of England. So I would anticipate, their policy rate's at 50 beeps. So I would anticipate you get 25 basis points tomorrow. You'll probably get some soft talking about potential for more QE. And then you'll probably have to wait and see how bad the economic data gets. Right now, PMIs are indicating contraction of about 40 basis points in GDP growth. If they go to full-on recession, 2 quarters in a row of contraction, then you'll probably get that last 25 beeps, some sort of QE, and it would probably force Theresa May to roll out some sort of fiscal stimulus, her being the new Prime Minister of the UK.
Dennis, I was really curious as to why actually you wanted to talk about the BOE. You and I don't normally talk about the BOE. We talk about the BOJ, the Fed, many other aspects, of course, but why was this important to you today?
Well, we own a number of UK names, of course, but specifically, this week, the BOE meets tomorrow, and it's a very large meeting. It's the first, full-blown meeting since the Brexit vote. So this is important, and it has greater ramifications for what the ECB might have to do in the future, and the Fed, of course. The Fed has already met in July, but there's rumblings that the Fed might be able to go in September based on the jobs report that we had. ADP earlier today was very strong. Non-farm looks like it'll be decent on Friday. So the BOA's decision is actually pretty timely.
Okay. We're going to have more with Sprott's Dennis Mitchell, and we're also going to take a look at a few of the investment themes that he's looking at right now. We'll be right back. We're back with Dennis Mitchell, Senior Vice President and Senior Portfolio Manager at Sprott Asset Management. Dennis, let's talk a little bit about what this macro environment leads you to do within your portfolio. How are you positioned these days?
Same as always, Catherine. We're trying to buy good companies that are generating strong results. So we're in the midst of earnings season, so the information that we have is the freshest it's ever going to be. So, just this morning, Brookfield Infrastructure Partners reported they had great results. Their funds from operations, FFO per unit was up 11%. They increased their distribution for the second time already this year. So year over year, their distribution's up about, I think it's like 12.5 or 11%. I'm probably confusing them with Macquarie. And all of their businesses were doing well. There's a little bit of weakness in their transport business, but importantly, they are going to deploy $1 billion of capital in the short term. They're going to raise $1 billion of capital through capital recycling, some projects and businesses that are mature, and the returns from those businesses going forward will probably be at the high end of their 10 to 15% FFO per unit growth or IRR targets. So that's a business that's doing very well for us, healthy weight in the portfolio.
I want to ask you a little bit about that in terms of who Brookfield Infrastructure. This is Brookfield Infrastructure, correct? Right. Yeah. So what are their end markets or what are their projects? Why is the business strong enough to increase distribution, increase FFO?
Right. So it's a conglomerate of infrastructure businesses. So they've got 4 core operating businesses: transport, utilities, energy, communications. It is truly globally diversified. So you've got North America, South America, Europe, Asia, and some of the businesses would be rail, ports, toll roads, electricity distribution, gas distribution. So they're businesses where the discretionary utilization of the services they provide is very, very low. I mean, regardless of how the economy is doing, you're going to want electricity, you're going to want hot water, you're going to need to get to and from work, whether it's at GM or whether it's at Walmart. So, when you look at that business, 90% of the revenue is recurring, 70% of it is either regulated or monopolistic, and 70% of it is either tied to inflation or regulated, and 60% of it has no volumetric risk. So it is a very, very transparent transparent, very, very high utilization business. And the key for that type of business is you want to be able to deploy capital going forward so that you can earn your regulated return on a bigger and bigger capital base. So when I talk about them deploying $1 billion in the short term, that's an opportunity for them to earn another 10 to 15% on $1 billion of capital being deployed.
What's the biggest risk?
Your biggest risk is a deflationary environment, right? Because if you've got contracts that are, inflation plus every year and you get into a deflationary environment, then you've got problems. Similarly, if you've got a
lower pricing power sounds like.
Right,
less
lower pricing power.
Lower pricing power.
Yeah, but you also have to remember that you're depreciating your asset base, right? So if you have a situation where your asset base is shrinking through depreciation and your allowed return is shrinking or you're exposed to deflationary environment, now you've got two things working against you in terms of generating returns.
Got it. That is not your base case at all. Okay. Let's take a look at the next one. Macquarie Infrastructure you like as well.
Yeah, I've been talking about this company for years. So Macquarie reported yesterday, again, great results, in particularly their Atlantic aviation business, which is essentially the core business is refueling private jets. That business is actually doing very, very well. It's bifurcated, so the domestic business in the U.S. is very robust, but as you can imagine, international travel into the U.S. out of Europe or out of Mexico or out of even Canada is a little weaker, and that's tied to the strong U.S. dollar and the weak overall global growth. But bottom line, this is a business that is growing its proportional free cash flow per unit by 9%. They also increased their distribution, but in this case, they increased their distribution for the 10th or 11th straight quarter, not year, quarter, in a row. And so year over year, the distribution's up about 12.5%. And then again, for this type of business, you want to see capital deployment. So their backlog has now grown to $370 million, and they've upped their capital deployment for this year to about $250 million. So great business, continues to grow.
Last question. What are the valuations like for Brookfield as well as Macquarie?
Yeah, so you're looking at usually EV to EBITDA multiples. PE multiples don't matter. So you're looking sort of in the 10 to 13 times range for these types of businesses, towards the high end of that range right now.
Okay. Dennis, we have to leave it there. Thank you so much for joining us.
Anytime.
Thank you.
We'll go to the news, and when we come back, Gus Papageorgiou, who is Associate Director of Technology Research at Macquarie Capital Partners, and he'll take a look at Shopify's earnings. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Keeping our eyes on Shopify today. It's trading higher. That's after the Ottawa-based commerce platform for small and medium-sized businesses reported revenue in the second quarter, which was $86.6 million. That was actually up 93% over the same quarter last year. The company says there was a strong increase in the number of merchants using its platform. Joining us now for a closer look is technology analyst Gus Papageorgiou. He is the Associate Director at Macquarie Capital Markets. Good to be with you today. Thanks so much for joining us, Gus.
Thanks for having me.
Let's talk a little bit about the strength of this company. I mean, it's still a very new company, so to see a number up 93%, that might be expected. But the momentum and the trend is in the right direction. Why is that happening?
Well, I think it's just, Shopify is just a great way to play the trend towards e-commerce. And I think we've seen, large companies and retailers already capitalize on the e-commerce trend. But what Shopify is enabling is small to medium businesses to exploit the e-commerce trend. It's now easier than ever if you're a small business person, to get on, to establish a website, an e-commerce ready website, and sell your products, globally through Shopify's platform. And I think that's why the company's benefiting.
Gus, I'm surprised that they don't have greater competition, or who is the competition?
There is competition for sure, but I think this is a classic internet scale play. I mean, you don't want to be number 2 next to Facebook. You don't want to be the second biggest search engine out there. You want to be number 1. And I think being number 1 gives you greater resources, greater brand awareness, and greater reach. And Shopify is exploiting its number 1 position to offer much better services at the same price for its customers, and the customers are flocking to Shopify.
It really has this brand awareness for sure. It certainly seems, but I just wonder if there's not somebody who can come in and create that same brand awareness quicker because they've got the deeper pockets.
Yeah, well, guys with deeper pockets have tried. I mean, Amazon did have an offering, and they shut it down late in 2014. And Shopify was, they identified Shopify as their transition partner. So bigger guys have tried and failed at this. I think what Shopify does really well is it understands small to medium businesses, and it understands the hurdles at getting launched and scaling, and it solves those problems. And that's why I think the company's been so successful at growing.
Gus, you know, one risk, though, might be, as you say, small and medium-sized businesses know this brand, but if, in fact, the economy turns for the worse, you will see small businesses go out of business. How much of a concern is that within your outlook for Shopify?
Yeah, I think that's a general concern. I mean, that's a macro concern. So definitely that would be a risk. But on the other hand, too, you know, if the economy worsens and people lose their jobs, they tend to start their own businesses, which would be positive to Shopify. So you lose on the sales front, which generates services such as Shopify payments, but you might gain in terms of new customers because more people will start their own businesses.
So let's talk a little bit about their business model in terms of where they generate the most revenue and what looks to be the most profitable area in terms of the volume versus the payment side of the business.
So the most profitable part of the business is basically their monthly subscription fees. So, you know, there's several different tiers, but on average, the average Shopify customer pays Shopify $50 a month, or just over $50 a month, and that is very high margin business. It's in, you know, the high 70s range. But in addition, they have services such as Shopify Payments, Shopify Shipping, Shopify Capital. Some of those, like Shopify Payments, is pretty low margin, but Shopify Capital and Shopify Shipping, which just kind of started to really impact the revenue line this quarter, are very high margin. So I expect to see the gross margins trend a little higher over the next few quarters.
I'm curious with respect to this growth, and of course if you have small companies growing, you often don't see profitability for quite some time, but why, given what you've just said, will we not see profitability until the fourth quarter of 2017?
It's because, you know, this is a land grab, right? I mean, you want to get as many people onto your platform as possible. If you look at last year, Shopify essentially had break-even EBITDA, but they spent $46 million in advertising. You don't need to spend $46 million in advertising, but if you want to grow the top line, it really helps. Same thing, you know, in the last couple of quarters. I mean, they're spending to grow their customer base. I think if this company wanted to, they could be profitable tomorrow. But I think the right thing to do here is to invest in growing the business, which is what they're doing. And meanwhile, the cash is still flowing because of its SaaS-based model. So I don't think investors are too worried about profitability. Gus,
when we look out 2 to 3 years, what does this company look like? I mean, I know you've got a $40 price target on it right now, or I think you do. It sounds like from what you've described that we might be underestimating the potential, but I don't know.
Yeah, no, if I look out 4 to 5 years from now, this company's, I think, definitely bigger. I mean, the e-commerce trend is well established. They have the pole position for small to medium businesses. I think we will see profitability over the next, kind of call it 6 to 8 quarters, and I think they'll just continue to improve the platform through better services for their merchant customers. And, you know, if you look at their customer base, I mean, in this quarter, the average Shopify merchant did about $12,000 of revenue in the quarter, and that's up 24% year over year. So their customers are doing really well. And as long as your customers are doing well, I think you're going to do well in addition.
All right, Gus, we have to leave it there. Great to have you on the program today. Thanks so much.
Thanks for having me.
Thank you.
Now to Paige Ellis and Bombardier.
Let's move to Paige Ellis on the top line story, Bombardier. What exactly is Bombardier saying, Paige?
Well, this is fresh off the press, but what was so interesting to us was that sort of buried in the release today was this announcement that Ilyushin Finance, which originally, once these orders from Air Canada and Delta are accounted for, was the 5th largest Bombardier C-Series customer based on firm orders, is now scaling back that order. So Ilyushin Finance, in case you're not familiar, is a Russian leasing company. Originally, back in 2013, they'd ordered 32 CS300s and had an option for 10 CS300s. Now we're learning this morning there's only going to be 20 CS300s and one turboprop, which is sort of a regional jet, and there's an option now on 5 more of the turboprops. So according to Bombardier, this is a reflection of current market needs at Ilyushin, but I'll point out that there has been a long for a long time, some concern that this deal would fall apart. You may remember last year, the company said that it was reevaluating the order because Export Development Canada had stopped offering financing to Russian customers as a result of Western sanctions against Russia. And it sort of, as Amber Kanwar raised this morning, it sort of raises the question, well, then what the heck is a firm order if they're able to restructure it? Firm is supposed to mean firm.
Right, and this is a step down from the firm portion of the order, not a step down on the options, correct?
The options are also actually stepped down as well, because the options on for Ilyushin were for 10 CS300s. Now it's for turboprops, which obviously are less expensive.
Greg, the optics are not good here. Obviously, this company and this stock is really an all-in bet on the C-Series program. What do you think of this news?
Well, this is certainly a big trading stock also. The Bomber's not a stock that you buy and hold for a long time. It's a trading vehicle. It's had a great bounce to start the year on optimism that this plane is going to do well and their orders are going to keep coming through. This is certainly going to cause some questions on that. Then you're going to come back to, do they need a bailout again, and different questions about that. So optics aren't great, but it's not the end of the world. It's not their biggest customer. So I think, well, it's interesting to see how it happens, but it's not the worst news. It's not the best news either.
The company posted a loss in the most recent quarter, but does say it's on the path to profit growth. Can you explain?
Absolutely. So the loss is largely attributed to the fact that it's ramping up production on the C-Series jet, right? Because it's through that development period. Now it's into production. And as for the C-Series, it was a really big quarter for Bombardier. A reminder that Swiss Air received the CS100, and then it entered into service. There was that first flight from Zurich to Paris. Lots of fanfare. So a big quarter for the C-Series. I'll also point out that revenue, while it beat in this past quarter, was actually lower than the same quarter last year. And that's, according to Bombardier, because of a reduction in revenue from the business jet division, which has come under strain. They've been cutting back some of their programs in the business jet division. Also noting that it's a very challenging environment right now. I guess people aren't opening their wallets for business jets these days. And a final point is that they definitely boosted their liquidity in this past quarter because of the first installment of the bailout from the Quebec government. No word yet on the federal request.
And is the company saying anything about either tranche of public financing today?
You mean the Quebec one?
Quebec or Ottawa?
Well, simply with the Quebec one, they simply said that they received the first one, that it certainly boosted their liquidity, and that they're receiving the next installment in September. No word that I could see on the request for a federal investment, and we've been trying to get word out of the federal government on what the sticking points are. We can't seem to really get a clear answer. The most clear thing that I heard is that it's largely now about jobs, not so much that dual-class share structure.
Okay. Any thoughts on the stock? Greg, is actually trading fairly close to a 52-week high, although well off, of course, its multi-year high.
Yeah, I would expect it to come back a little bit on the back of this news. Certainly, and on the federal bailout, I think I agree with you on the jobs, but I think the multi-vote is the big sticking factor. If optics for the rest of Canada outside of Quebec are, how do you bail out a company and not have the family give up multi-vote shares? So it'll be interesting, but I don't think they're down to the path that they really need that federal bailout right yet.
Okay. Thanks, Paige, for bringing us up to date on one of the big Canadian corporate stories of the day on a busy morning out there in the business world.
We'll go to a break, and when we come back, David Prince, who is the founder of Harbinger Capital Markets Research. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
The Canadian dollar fell out of bed after our economy unexpectedly shed jobs last month. We figured we'd maybe get 10,000 more added to the economy. Didn't happen. For a look at that and our American counterpart, we turn to Harbinger's David Prince. Good to have you with us again.
Nice to be here, especially on a day like this. It certainly had disruption in the market, so yeah.
Well, okay, with that in mind, 31,000 jobs lost, and the jobs that were lost were the full-time, high-quality jobs that you want to see grow in an economy.
And remember how we were talking about the impact of a lower dollar was not going to stimulate the manufacturing sector as much as what was thought. It did, however, in that report have an 11,000 pickup. That's nice. But in the area that's been driving the economy, which is the primary driver now in the Ontario economy for sure, is the construction industry, which we did see. So putting it all together, I'm a foreigner. I've been buying the Canadian dollar because I'm getting a higher yield. Now I got a whoops. That economy's starting to sputter in a lot more areas than what I thought. So the downdraft in terms of the energy is not being offset. Now, what's interesting is international players have been picking up both the Aussie dollar and the Canadian dollar of late. And during the day, we saw a significant change whereby the Aussie dollar rose above. They do provide a better yield on the longer term, but the strategy is simply that if people looking for where the growth is and what is discounted the most, they had included Canada. Well, that seemed to have had an abrupt turn today, and obviously this is going to have to play out over this next week.
I spoke earlier to an economist who, when we talked about the Ontario problem, it's the economic engine of the country, it's a third of the overall GDP here, that we didn't see the manufacturing strength on a subpar Canadian dollar that we were hoping for by this time. We were told 18 months ago, it takes 18 months for a subpar dollar to help the manufacturing. And his comment was that, well, when we think manufacturing, we think a blue-collar worker, screwing a bolt onto a car, but it's more high-tech now, and it's not seeing the same growth rate as first thought.
There's some of that, but let's be real. The main thing that's been curtailed and not present is the auto side. Let's not kid ourselves. The auto side dwarfs a whole bunch of industries that they may want to talk about. But the reality is, when you're down as much on the auto production as we are and seen it go to Mexico, which we've lost, that says something about the cost factor. So let's not, this is a political nonsense that people use as an excuse, just like they've been dead wrong on their manufacturing outlet.
Well, then to your point, we've been importing manufactured cars into this country and exporting the car parts themselves.
Which is why the car part guys did all right this week and why Magna had some pretty good returns. The big issue on that front, which started this week, was the report that came out of Ford, which we did talk about last Friday, but boy, that came out of nowhere with the whole announcement of just how poor the sales were in the month of July for all three of the big American known producers. That said, what we're seeing is that if there's going to be a recovery, which this week everybody says recovery, here's where the dilemma gets for the investor. I've got rates at historic lows. I got everybody cutting rates. Politicians have told us for years, cut rates and everything will be fine. Well, they obviously don't know much about history, and clearly after 40 years, we've seen this whole program with Japan not play out in the way that people had talked. So that solution, which again was joined by the Bank of England, is not the way to get the growth that everybody thinks is going to happen if they look at previous economic models.
I am looking at the expectations for the Americans to raise their overnight lending rate. And this is all on the back of the better than expected reading on jobs out of the U.S. I now have a 3 out of 4 chance the Americans raise the overnight lending rate in September.
So in June, we had that wonderful time that everybody was looking at it before we had all the June numbers come in, and clearly what's happened is that is subject to change like mad. It's one of the most speculative vehicles. So let's think about the probability before a highly contested American election of them raising rates. This is ludicrous. You either have a strong economy in the United States where therefore you stop the crutches, or the numbers that we're seeing are only temporary, and there's obviously anticipation of a further downset in the economy, and that justifies keeping rates low. Something's got to give, and obviously when it comes to a political decision, they'll postpone rather than giving you a decision. So my belief is the only time that I see a rate potential in the United States increase is in December, after the election.
So then what does that mean for the bond component to our retirement portfolios and filtering through to the Canadian dollar?
Great point. So here we are with these back-end rates being the 10-year or longer rates. And they have been certainly down over this last couple of years. We've seen, of course, negative rates for 10-year maturities in Europe. And, of course, the report from Europe this week was awful. That's the only way to describe it. When you have the engine of growth being Germany and it has negative manufacturing growth, that tells you a lot. But that said, looking at the rates, Canada still remains relatively attractive. The big thing for Canada is we cannot afford to have rates go up.
Right.
And why is it that we get this hue and cry about getting rates down? It's not because of the economy. It's because the governments need the money. If we cannot finance, we are in trouble. If rates are low, that gives us more money to spend. And in order for this thing to sort of clear the decks, you need something that's happened, and it's obviously not what people want to hear. But the bottom line is, if you keep it unnatural, you're going to have an unnatural ending.
David, great having you with us as always. Thank you.
Thank you.
David Prince is the founder and president of Harbinger Capital Markets Research.
Now to Gerald Celente in conversation with our affiliate BNN's Amber Canmore.
My next guest says central banks have failed to induce true economic growth globally and just aren't really that helpful. Gerald Celente, global forecaster and publisher of the Trends Journal, joins me now with more. Gerald, I think a few years ago you might not have found too many people in your camp, but now that we're on 6-7 years of this global central bank policy experiment, you must have more and more in your company that share your sentiment.
Oh, of course. And, when it began with too big to fail in stimulus programs, we said right when it happened, this is not a recovery, it's a cover-up. And all they've done is covered up the equity market problems with cheap money. And when you look, Amber, at where all the growth is coming from, take a look in the States. You've had stock buybacks in the first 3 months at about $150 billion. They're borrowing the money for nothing. Same thing with M&A activity in 2015 at record highs. So it's only boosted those fields. But when you look at GDP numbers here in the States, what are we doing? We're rushing ahead this year with a 1% GDP growth. Over there in Europe, basically nothing. So when you look at the real numbers, there's been no recovery. It just boosted the equity markets and it has built other bubbles.
Those who look at the actions, the extraordinary, unprecedented actions that central banks will say it would have been worse were it not for them because governments around the world were either unable or unwilling to step in with fiscal help.
Well, they could say that, but what they've done is they've made the too big to fails even larger. And so that's all they really did. So rather than the too big to fails taking their hit, and in capitalism, you rise and fall on your own merits, they changed the game. So number one, we can't call it capitalism anymore. And number two, when you look at what's really happened, again, it hasn't enriched the population, it's only enriched the rich. And again, I'm not making these numbers up. Here in the States, it's a fact, 95% of the wealth that's been created since 2009 has gone to the 1%. The Oxfam study, 62 people have more money than half the world's population combined. So what it's done, it's created a war against we the people because you have record low interest rates now. And when I was a young man, I used to hear these stories of people putting money in a bank, getting interest rate high enough where they could retire on it and move to Florida. Those days are gone.
Do you get a sense, though, do you think the U.S. Fed will escape your criticism as it seems like they have the data they need to start to normalize interest rates, or put air quotes around normalize, I guess. They're not engaging in asset purchases, and they're slowly making their way back to historical norms.
Well, look what did they do? They raised the interest rates one time in 10 years. 25 basis points. Go back to last December and go through up until May. They were going to raise interest rates 4 times in 2016. They haven't raised them at all. So they're keeping it going with these low rates because it keeps the equity markets alive.
I have to ask if whether you think, as more and more people are sharing your thoughts, whether you think central banks are realizing that they're at a point where they're no longer as effective, and I'm thinking about the Bank of Japan, perhaps even the ECB. Do you think that we're at a point where the central banks are reflecting on their own policies and realize that there's only so much they can do?
I thought that when the Bank of Japan decided not to go further into negative interest rate territory, but then I saw what happened with the Bank of England. And now they have this unprecedented quantitative easing, and they lowered interest rates again. So, and with the quantitative easing, by the way, now they're not only buying government bonds, they're buying corporate bonds. So, this is unprecedented, as is negative interest rates. And look at the negative yield bond rates. What are they, $13 trillion? So you're going to buy a bond now, cash it in 20 years, and you're guaranteed to get less than what you bought it for? They're making this stuff up, And I don't think they know where they're going with it.
Since you're a forecaster, how does that end? Since we have no basis of history of that massive amount of government debt that is yielding negative, as you just mentioned, how does that end? How does that unwind?
I think they're building a bubble in the greatest in modern history, and when it blows up, it'll be worse than the crash of 1929. Look at the housing prices going up to record highs around, look up in Canada, up in Vancouver, what are they up? 32% in 1 year? Go to Australia, Sydney, the other hot countries. They're building bubbles, and the equity market bubbles. So when it collapses, we believe it's going to be the worst in history.
Gerald, I wish we could end on a more optimistic note, but unfortunately we can't. That's our time. Thanks so much for joining us.
Thank you.
Gerald Celente, global forecaster and publisher of the Trends Journal.
That's it for Money Talk. Thank you for joining us. Have a good week, and we'll be back 2 p.m. next Sunday. I'm John Budden, and you are listening to 580 CFRA.